Hello and welcome to another lecture in actuarial statistics. I'm Eunice Frimpong from Accra Technical University, and today we are diving into an important topic in insurance, policy limits. Whether you are watching this as a student preparing for exams or someone curious about how insurance really works behind the scenes, you are in the right place. Now let's begin with a basic definition. A policy limit, also called a benefit limit, is the maximum amount an insurer will pay for a single loss under an insurance policy. In other words, no matter how large the actual loss is, the insurer will not pay more than the policy limits, which we are also calling the benefit limit. Let's look at two simple cases. In case one, if the loss X is less than or equal to the policy limit U, then the insurer pays the full amount of the loss. In the second case, if the loss exceeds the policy limit, the insurer pays only U, and the policyholder pays the rest. So, in the concept of policy limit, what we are saying is that the insurer has a maximum amount of money they will pay, regardless of the amount of loss. So if the loss exceeds that limit, they pay only up to that limit. So policy limits cap the insurer's responsibility. Anything above, that's on the insured. Now let's compare policy limits. Let's compare policy limits with deductibles, which we discussed in a previous lecture. A deductible sets the minimum amount the insured must pay. The insurer only steps in for amounts that are above the deductible. But a policy limit, on the other hand, sets the maximum the insurer will pay. The insured takes care of anything beyond this. So to summarize, deductible caps the insured's minimum liability, and the policy limit caps the insurer's maximum liability. They serve opposite but complementary purposes in managing risk. Let's now consider two scenarios. Scenario 1, deductible only. The insured pays up to the deductible, and the insurer pays everything above that with no cap. For case 2, policy limits only. Insurer pays up to U, which is the policy limit, and the insured covers any amount that exceeds the policy limit. Each policy type shifts responsibility in a different way. You'll often see both used together in real-world insurance policies to manage risk more efficiently. So, why do insurers include policy limits? First of all, to control their exposure to very large, unpredictable claims. Second, to allow for tiered pricing so that higher risk individuals can still get some coverage at an affordable cost, right? So if you're a very high risk individual, you will not simply be dismissed or ignored, but you still can get some coverage for yourself. Just that there will be a limit to what you can possibly receive in the case where you suffer a loss and you need to be reimbursed. Then thirdly, policy limits encourage insureds to reduce extreme risk, such as installing fire alarms or driving safely. They are especially useful when combined with deductibles, creating a shared structure of responsibility. Now we express the insurance payment mathematically. So under policy limits, once again, we have X being the loss amount, Y is the insurance payment, and U is the policy limit. If the policy has no deductible, then we say that Y, the insurance payment, is equal to X, which is the loss, if the loss is less than or equal to the policy limit U. or y is equal to the policy limit if the loss is more than the policy limit. Another way of representing this compactly is y is equal to the minimum of x or u. So once x is more than u, then y is equal to u. But once x is less than u, then y is equal to x. So this formula ensures the insurer never pays more than u. Let's define unreimbursed loss in this context, in the context of policy limits being present in the contract. Unreimbursed loss, denoted as D, is the amount the insured pays. So under a policy limit, it becomes Z equals 0 when the loss is less than or equal to the policy limit. And then Z is equal to X minus U when the loss is more than the policy limit. So in this case, the insured will pay anything above the policy limit. So you take the policy limits out of the loss and then you get the rest, which is what the insured pays. So once again, this mirrors what we saw with deductibles, except now we are capping the insurer's side rather than the insured's side. How do we compute the expected payment for the insurer under a policy limit? Now, if X is discrete, then the expected value of Y equals the sum of X times the PMF of X plus U times the probability that X is more than U, where X is running, the loss is less than or equal to the policy limit. So this expected value indicates that in the case where the loss is less than or equal to the policy limits, the insurer pays X times the probability that the loss is equal to X, or which we are using plus in probability, or stands for, you can use addition in place of or. So he pays X or he pays U in the case where, given the probability where X is greater than the policy limit. So if X is continuous, we use the integral notation here. And we have X times the PDF of X or U, the integral of f of X, where the loss is more than the policy limits. So we can simplify this to be integral from 0 to U of X times f of X dx plus U times the probability that the loss is more than U, which is being represented by the survival function here. So the first case here is when the loss is less than the policy limit. Second case here is when the loss is more than the policy limit. So SXU is equal to the probability that X is greater than U. It captures all those losses that the insurer doesn't fully cover because of the policy limit. Here's a quick recap. The insurance payment is capped by U. If a loss exceeds U, the excess is not reimbursed. Now for calculations, we use the actual loss for X less than or equal to U, and then the policy limit, the cap U, when X is more than U. So understanding this helps us model and estimate the insurer's true cost more accurately. Now here's a practical example. Given that the policy limit U is equal to 3, and given that the loss follows the Poisson distribution with lambda equals to 5, and the insurance payment Y is equal to X in the case where X is less than the policy limit, and then 3 in the case where X is more than the policy limit. Now the goal is to compute the coefficients of variation of Y, which tells us how much variability, the coefficients of variation tells us how much variability exists in the capped payment. So we follow 3 steps. We're following steps. So let's follow these steps. First of all, compute the expected value of Y. So these are the steps we follow. We must first of all know the PMF of the Poisson distribution, and it's given as this. Probability of X equals to X equals E to the power minus lambda times lambda to the power X all over X factorial, given that X is equal to 0, 1, 2, and so on. So we'll start by computing the expected value of Y. Then we'll find the second moment of Y. Then we find the variance of Y, which is the expected second moment of Y minus the first moment of Y squared. Then we find the coefficients of variation of Y, which is the standard deviation of Y over the expected value of Y. So the first step, to find the expected value of Y, is equal to X times the probability that x is equal to x, given that x is running from 0 to 3, or is equal to 3 if x is more than 3. The second moment will be given as e of y squared, then we square the x here, and we also square the policy limits, but everything else remains the same as in the first moment. So using lambda equals 5 and e to the power minus 5 being approximately 0.0067, we have the probability that x equals to x being equal to 5, which is lambda to the power x, times e to the power minus 5, which is e to the power minus lambda. Then we have over x factorial. So you can fix in the values accordingly. So we have expected value of y being equal to 2.8282, and then the second moment of y being equal to 8.2487. So what happened here is that x is running from 0, 1, 2, and 3. The maximum value here is 3. So for the first one, for example, you're going to sum over the interval x running from 0 to 3. So you compute this for x equals 1, 0, compute this for x equals 1, compute this for x equals 2, compute this for x equals 3. And then whatever value you get, you come to find the probability that x is greater than 3, which is going to be 1 minus the probability that x is less than or equal to 3. So given the expected value of y in the second moment, you find the variance by taking the second moment minus the first moment squared, which is equal to this minus that, and it's equal to 0.2520. Please take your time and go through finding the expected value of y using the PMF here and then the values here. And try to get and hope that you will get this answer. So try to find the expected value of y in the second moment and verify that these expected values of y's in the second moment are correct. Now we move on to find the coefficients of variation by finding the square root of the variance, which gives us the standard deviation all over the mean. So if you go ahead to calculate this, you are approximately getting 0.177. So this tells us that the payment under the policy limit is moderately variable, a useful insight for pricing. So there you have it, policy limits explained from definition to application. In real-world insurance, policy limits are everywhere, whether it's health, motor, or property insurance. As actuaries and future risk managers, understanding how they affect risk sharing, premiums, and payment variability is essential. If you found this helpful, please give this video a thumbs up and share with your friends. And don't forget, next up, we'll explore how both deductibles and policy limits work together in insurance modeling. Thank you for watching and see you in the next class.